Welcome back to the Deep Dive. We're looking at the final market data for 2025. We're on December 30th, and this is always a strange time of year.
It is. You get these high-stakes strategic moves, but in a really, really quiet, low-volume market.
And our mission today is to sort of decode these year-end signals. We're seeing a huge split in where the money's going. Interest rates are still sticky, and there are these tensions just under the surface with liquidity. Okay, so let's unpack this because the market is telling two completely different stories at the same time. One is this almost frantic excitement around AI.
Right.
And the other is this deep, deep sense of caution, of fear that's pushing people into the safest assets they can find.
And that's the whole story, really. It's that extreme split. I mean, if you had to sum it all up, the one-sentence takeaway is this. We're in a market defined by low volume, weird seasonal liquidity, and rates that are still pretty high.
Which means capital is splitting aggressively.
Aggressively. You're either chasing AI or you're hoarding gold.
Yeah.
So for you listening and trying to position for the new year, the data is just screaming that you need to be defensive. Strict position management is everything right now.
Let's start with that anchor point, the one that's really defined the last 6 months. Interest rates. The 10-year Treasury is still hanging around 4.12%.
Yeah, it just won't budge much.
And at middle to high level, it's just this constant pressure, isn't it? It's a headwind on valuations for, well, almost everything.
Especially things that rely on future profits. And if you connect that to the bigger economy, you see why the Fed is so cautious. I mean, inflation is down from its peak for sure, but it's still showing this stickiness.
What are we seeing, like 2.6, 2.8%?
In that range, yeah.
Yeah.
Stubbornly there. And at the same time, the labor market is balancing. The non-farm payroll number was only around, what, 60,000?
Right. So not a collapse, but definitely not strong.
Exactly. It's not weak enough to scream recession, but it's not strong enough to justify more tightening, so the Fed's just stuck. And those sticky rates are the result.
That stickiness is so key because it makes you look harder at the little anxiety signals that are popping up, especially in the short-term money markets. And this is where it gets really interesting.
It does.
The liquidity signal from the Fed's tools. It seems like it's flashing a contradiction. I mean, we expect things to get weird at year-end, but this pattern feels like real tactical anxiety.
It absolutely is. So for anyone listening who doesn't track these Fed tools every single day, you might wonder why a drop in one tool, the on-RRP, and a huge jump in another, the standing repo, is such a big deal.
Okay, so break that down for us. What are those two signals telling us about what the banks are doing?
Right. So the on-RRP, the reverse repo, that's where big institutions, mostly money market funds, can park extra cash overnight with the Fed and get a return.
Currently about 3.5%.
Right. And on December 29th, usage of that fell to just over $10 billion, which on its own you might think, okay, maybe they just don't have a lot of extra cash. But, and this is the kicker, at the very same time, the Fed's standing repo lending facility saw a huge increase. It jumped to nearly $26 billion.
So wait, institutions are borrowing aggressively from the Fed with one hand?
Precisely.
While not really parking much cash with the other.
Exactly. Repo is totally different. It's short-term borrowing of cash, usually against treasuries. The source calls it passive scheduling, but really it's just year-end balance sheet dressing.
They need cash on the books for regulatory reasons.
They need it on the books as the year closes. So by hitting that standing repo facility, they are actively, maybe even urgently, managing their cash needs down to the wire. It's a signal of this underlying institutional anxiety about having enough cash right when they need it.
And that deep, short-term need for cash from the big players, that explains the great divergence we're seeing everywhere else, doesn't it?
Okay.
If the institutions are anxious, it makes sense the rest of the market is just completely split.
100%. They can't decide if they need liquidity or if they need exponential returns.
It's an inability to choose.
And that's perfectly reflected in the sentiment indicators. They're all over the place. I mean, you look at the VIX, the main volatility index, and it's low, around 14.2. That should mean everyone is calm.
Right, complacency.
But then you look at something like the crypto fear and greed index, and it's buried in extreme fear, like down at 23.
That's a massive disconnect. How can those two be so far apart? Is one of them wrong?
They're talking about different markets, and that's the key insight here. The VIX is about the big, sophisticated S&P 500 options market, which is pretty stable, driven by a few big tech stocks. The crypto index reflects the highly leveraged, often retail side of things. And that extreme fear reading tells you that speculative money is terrified of a sudden drop. It makes it really hard for a short-term trader to jump in, even if the main market looks calm.
So even with a low VIX, the risk of a sudden spike is still there.
Oh, absolutely. The source is very clear on that. And then you layer on the US dollar index, the DXY. It's weak, around 98.0, but the really shocking number is for the year. The dollar is down almost 9 to 10% for 2025.
That is a huge move for a reserve currency.
That 9 or 10% drop is maybe the most important macro takeaway. It's not just a number. It's a global signal that faith in the dollar's stability is, well, it's eroding. This is what's fueling that crazy high Bitcoin to gold ratio we're seeing, around 19.5 times.
So investors are just frantically jumping between pure speculation like Bitcoin and pure safety like gold, all because they don't trust the traditional safe haven anymore.
It's a flight to non-sovereign assets.
Right.
Exactly.
Yeah.
And you see that playing out in the big indexes, which are just consolidating at these really high levels. The S&P 500 ETF, VOO, is at about 632. The QQQM is around 255.
But that stability is kind of deceptive, right? It's really just a handful of huge tech names holding everything up.
It is. Let's talk about those drivers. We know who they are. You've got NVIDIA at 188, just directly benefiting from all the AI infrastructure spending.
And then you have Tesla sitting around 460, just bouncing all over the place based on delivery numbers one day and robotaxi hype the next.
And we have to mention a newer player, CRCL, Circle Internet Group. It's trading around $80. Now, this isn't just another tech stock.
No, this is a regulatory play.
It's a direct play on the future of digital finance. It's a huge stablecoin issuer. So its price action is basically telling us what the market thinks about potential crypto legislation in 2026. It's a regulatory proxy trade.
And now let's go to the riskiest end of the spectrum. Crypto itself has been volatile. Bitcoin is consolidating between, about 86.8K and 90.2K.
Yeah, and there was that sharp little dip below 87K on the 29th. ETH is holding around 2.9K. But this consolidation is happening while that fear index is at extreme fear.
Which tells you it's unstable.
Deeply unstable. Any shock could cause a huge drop, which is why risk management is it's non-negotiable there.
And then there's the stuff that's pure psychology, the pre-stocks market.
Oh yeah, this is the Wild West.
For anyone not familiar, these are basically derivative markets for shares in private companies. And the prices are all over the map. Anthropic is quoted anywhere from $180 to $320.
And look at OpenAI. One platform has it at $1,050, another at $1,150.
What does that even mean?
It means there's no real valuation mechanism. It's just pure demand and FOMO, fear of missing out. This isn't investing based on fundamentals. It's a high-stakes lottery. These are for tiny, tiny positions, if any at all. It's a barometer for pure, irrational speculation.
So, putting it all together, you're looking at this data, planning for 2026. Low volume, high rates, institutional anxiety, this great divergence. What does it mean for your money?
The strategy coming from the source is overwhelmingly defensive and layered. First, you have to realize that with the dollar down almost 10%, just holding cash is actively costing you purchasing power.
So cash is not a safe haven.
Not right now. So the core idea is a phased, layered entry. You prioritize broad ETFs like VOO and QQQM for that market stability, but you only add small, focused positions in the real AI leaders like NVIDIA or Google.
Okay, defense first, then some targeted offense.
Right.
And the hedge.
With that dollar weakness, a small allocation to physical gold or a gold ETF is pretty much essential. It's not just a crisis hedge anymore. It's an offset against the risk that the Fed is losing control over the currency's value.
And for crypto?
Tiny positions, absolute strict stop losses. The key number to watch for Bitcoin is that $85,000 level. If it breaks below that support, it could signal a much, much deeper correction is coming.
All right, and we'll leave you with this final thought as we close out the year. The Fed meeting minutes are coming out soon, and the market has already priced in a bunch of rate cuts for 2026.
Aggressively priced them in.
But given that the US dollar just lost 9 to 10% of its value in a single year, how much room does the Fed really have to delay those cuts if the economy shows any more weakness?
That's the billion-dollar question, isn't it? If they delay, they risk the dollar's credibility. If they cut too soon, they could reignite inflation. What the outcome of that conflict means for the dollar and for safe haven assets, that's the biggest question heading into the new year.